Welcome back to Between Bells. This week we'll be bringing you all of the big news from the Cannes Lions International Festival of Creativity. Earlier today, our own John Steinberg spoke with Aryeh Bourkoff, CEO of LionTree, about the changing media landscape with the merger of Yahoo and Verizon.
What is next after that? Will Verizon go and look to buy a large content company? Will Comcast feel that NBCU is too legacy and not enough and they need to either take out BuzzFeed or Vox or Vice or something like that? Or will we see more small media acquisitions to kind of round out things?
Look, all of the above is the short answer, but from the perspective of the large cap companies, you have a number of different forces at play. You have the established content companies with very strong brands traditionally, trying to migrate those brands direct to the consumer. So whether you're a Viacom or a Time Warner or you're a CBS and you have brands like Nickelodeon or Showtime or a Cartoon Network, you need to get to the consumer directly. Right, so that is trying to happen and engaging consumers directly with new advertising supported models. In fact, in the new Hulu package, the ad-supported service is actually still very popular. It's not just a subscription model. So consumers are still attuned to advertising. The second thing you're seeing are the distribution platforms, the AT&Ts, the Time Warners, the Comcast, the Charters, the Verizons of the world, trying to have much more say in actually the end user taking advantage of the platform. And that means a lot more vertical integration, a lot more content distribution coming together. And the third component of it is the technology platforms. These massive companies like Facebook, Amazon, Snapchat, Google, et cetera, not only accumulating understanding of the consumer and data measurement, but now getting into new businesses using their disruptive technology. So Amazon obviously the most notable with Whole Foods. I mean, the technology companies have gotten so large and so powerful that the next evolution of their progress will be into other traditional industries, like retail.
But it seems if you look at the traditional distribution companies, the Charters and the Comcasts, the Coxes, the Verizons, they've sort of more or less fallen dramatically behind in terms of technology to Google, Facebook, and Amazon. And now it seems like the move has been to remerge content with distribution. And if I had to bet, I would say that now every one of them is going to turn and look at what AT&T has done with Time Warner and say we can't be in a disadvantaged position. And then as the distribution becomes a commodity, this is where the leverage is.
Yes, the question is, there are very few traditional content companies left to acquire. Creates a bit of a scarcity value dynamic.
Yeah.
There are a handful of them and very few that are actually not owned by families, which are truly public companies. So you will see, I think, those get acquired over the next few years, maybe even sooner. But the new approach for these same platforms, whether you're Verizon, AT&T, Comcast, Charter, is to look at newer content companies, like Cheddar, for example, right, or others.
No, and many of them have invested in us in a minority way.
Correct.
Yes.
The issue there is, one, there's no issue. These companies are compelling and fast growing, but there's less materiality for them than buying an existing player. So I think you're going to see them do both. You're going to see them buy growth and the emerging companies that are really compelling, or invest in them, and you're going to see them buy the traditional assets that are left.
Do you think that you'll do a deal in the next year that will be very much out of the box, like this Amazon Whole Foods deal? Like you can talk about it. People can talk about how we saw this coming and it was expected and Amazon was doing, but you know what? This was still the kind of thing where you thought for a moment, was this an Onion headline, right? Like it was that shocking the first time that you read it.
Yeah.
Do you think in your space there'll be deals that are equally head-scratching in a way?
I think very few of the deals that we will announce or we'll work on will be predictable.
Yeah.
And you go back to even...
Over the what?
Will be predictable.
Over when? Over what period of time did you say?
Well, over the next 12 to 18 months.
Okay.
I think Verizon, when they looked at buying AOL, which we advised on, and Yahoo, were not thought of ahead of time either, right? So at AT&T, Time Warner, maybe that was a long time ago, but I think people are looking at different ways to transition their business models, and there's not one boilerplate template to do that. There are different ways to do that, whether it's starting companies or getting scale in different ways. And the end game is obviously locking your consumer relationship with more products and services, being very relevant, and creating scale and growth. And that can be done in different ways. And we're seeing gaps. So normally you look at these gaps in the system and you look at the stock markets and say, well, stocks will go up, stocks will go down. The way we look at it from an advisory perspective is these create issues and problems to solve. How do we solve those problems? Some of those will be solved with capital. Some of those will be solved with just advice and relationship building, but a lot of it will be solved with M&A and mergers and acquisitions and ways to plug holes and create more defensible growth assets for these traditional players.
That was John Steinberg with Aryeh Bourkoff, CEO of LionTree. A reminder to catch all of our coverage from the Cannes Lions International Festival of Creativity.